Hey, what's up, everybody? So TCA Thursday again already. So I figured I would this week talk about an NJHMFA $15,000 grant that's being given to first-time home buyers. It's a really popular loan. It has been a really popular loan for a few months now, but not a lot of people know this. But there are actually three different loans that you can get that would be coupled with the grant from the state that you can utilize. So I wanted to talk about maybe just the slight differences in those three programs with you today. I'm going to show you a TCA so it's easier for you to understand. But anyway, if you're not familiar with the program, the NJHMFA stands for the New Jersey Housing and Mortgage Finance Agency. Right now, they are offering $15,000 as a grant for first-time home buyers. Now, the $15,000 is a forgivable grant, meaning that if you stay in the house for at least 5 years, or you don't refinance for those first 5 years, then you don't owe any money back to the state. If you did refinance or move, then you would owe money back to the state. The grant works as essentially a silent second mortgage. It's $15,000. And again, there's a couple different guidelines that need to be adhered to in order to be able to qualify for that, which I'm going to go over with you in a few minutes. But I wanted to create a TCA to show you the difference between the programs. And I thought we can maybe talk about that for a few minutes. So I'm going to share my screen or bring the TCA into this screen and just go over that with you real quick, okay? So let me bring the TCA into here. Okay, and the first one that you'll see on the left here that I highlight for you is the first-time home buyer. One of the programs made available is a first-time home buyer program. And so what I did was I did the same purchase price across the board for all three programs, $325,000. Just so you know, the program, the purchase price for all three is $325,000. This way, I figured we can compare apples to apples, kind of thing. Homeowners insurance across the board, I used $125 a month, which would be equivalent to about $1,500 a year. And taxes for each scenario, I used $450 a month. As well. So that stuff is constant with the three different scenarios. So going back to the first-time home buyer loan, I have a purchase price at $325,000. Now, the first-time home buyer, the first mortgage with the first-time home buyer program is an FHA loan. So it's just a regular run-of-the-mill FHA loan. Okay, so you can put as little as 3.5% down. So at 3.5% down, after you add back in the upfront mortgage insurance, your mortgage amount would be $319 and change. The interest rate on the first-time home buyer program right now is 6.25. So that would make your principal and interest payment $26.83, assuming the taxes and the homeowners insurance I mentioned a minute ago. And so with a regular FHA loan, you would need to bring about $23,000 with you to close. Now, enter in this grant of $15,000, and then you would need to bring in, let's say I'm going to take that grant and I am going to give us $15,000 down. I don't know where I could put that. Okay, so can't do that. So anyway, so instead of it being $23,000, 23,000 minus 15. Okay, the amount of money that you would have to bring to closing with the first-time home buyer program is about $8,000. So you can see why it's a very popular program. The state's giving you $15,000 that you can use, and you can really, if you get the right purchase price, you can even get a seller's concession. It's possible to set yourself up to buy a house with no money at all. All right. Now let's move over to the Homeward Bound one, which is the middle program here. Same purchase price, same loan amount. As you can see, the interest rate is different, right? So you might ask yourself, why would somebody go with the the Homeward Bound program when the first-time home buyer program, the interest rate's 0.5% lower? That's a good question. The answer to that question would be because the guidelines are a little bit different. There's something called ratios in the mortgage world, and ratios are essentially percentages of your monthly income, right? And the first-time home buyer program requires that somebody's total monthly debt does not exceed more than 47% of their total monthly income. With the Homeward Bound program, that I believe goes up to a 50% back ratio. So you get a little bit more leniency there with the Homeward Bound program. Okay. Again, same amount of money. Well, your payment's approximately, a little bit more than $100 more. Same amount of money to close. Again, if you were to get the $15,000 from the state, that money would drop to about $8,000, a little bit more than $8,000. All right. I'm trying to think if there's any other nuance differences that I want to tell you about as far as the ratios go, but I don't think that there is. Okay, so now let's move over to the HFA Advantage. This actually is a conventional loan. Again, there's first loans with the first two columns, or the first two columns. The first-time home buyer would be an FHA loan. The Homeward Bound would be an FHA loan, and then that $15,000 is a silent second mortgage given to you at closing to make up the difference. So again, these totals would be $15,000 less after you got the money. Okay, and then we go with this FHA Advantage loan. This is actually a conventional loan, not an FHA loan. As you can see, the interest rate is again higher on this one than the other two, and the benefit on that one is in the mortgage world, there's a front ratio and a back ratio. A front ratio is essentially somebody's housing payment or proposed housing payment, more or less, divided by their monthly income. And there's no required ratio with this HFA program. So you can have a 44% front ratio and less than a 50% back ratio. This would be good for somebody who maybe has no debt at all, no credit card debt, no car payments, nothing like that. Just want to buy a house. So that might be a really good program. If that sounds like you, that might be the best way to go. All right. Again, the amount of money that you would need to bring to closing in this one is $21,516. You subtract the $15,000 that you get from the state, and it's more like $6,500 that you'd be bringing to closing with you. So I would like to go over these things with whoever I'm talking to. Maybe it'll be you. Maybe you're interested in one of these NJHMFA grant programs. I can talk to you about the first-time homebuyer program. I can talk to you about the Homeward Bound program. I can talk to you about the HFA Advantage program. Anybody from my team can as well, and we'd be happy to. So if this sounds like something that you'd be interested in, please let me know. You can either send me a message right through Facebook. You can call me. My cell phone number, I don't know if it's around, so I'll give it to you now. It's 732-684-5771. You can shoot me an email as well. My email address is lherbert@advisorsmortgage.com. A couple different things that I also want to talk to you about with these programs is that most of them, actually all three of them, will require a month worth of reserves. And what reserves are, reserves mean that you have a month's worth of mortgage payments in the bank after you close. So, for example, if I were to go back to, let's say, the Homeward Bound program, $27.88 is the payment. So you would need to have at least this much left over in the bank after you closed. Okay. Another thing for these to qualify are income limits. So with the first-time home buyer program, give me 1 second. The first-time home buyer program, where'd it go? Okay, first-time home buyer program, and I'm talking Ocean County. I mean, my office is in Ocean County. Most of my business is done in Ocean County, New Jersey. So for a 1 to 2 family household in Ocean County, for the first-time home buyer program, you need to be making less than $123,600. And for a 3+ family household, you need to be making less than $142,140 a year. For the Homeward Bound program in Ocean County, again, you need to be making less than $152,460. That doesn't differentiate between family size. And for the HFA Advantage home buyer program, you need to be making less than $152,460 in Ocean County. And the other thing with that about the HFA program is that if you're making less than $90,000, you get a reduced rate with mortgage insurance, which is actually very helpful. Also, what else? If you have more than 25% liquid assets, in the bank, you won't qualify for this program. Liquid means like in your checking account or savings account, if you have X amount of dollars in your retirement account, that's not viewed as part of the 25% asset test. So that's good news. So as you can see, we know a lot about these programs. Again, my team knows a lot about these programs. We'd love to help you. If there's something that I didn't mention and you have a question about it, just let me know. You can shoot me a message on Facebook, email me, or call me. That's about it, man. So if you have any questions, just let me know. Other than that, hope you have a great day, and maybe we'll hear from you soon. See ya.